Hi, Jordan. You recently talked about the pervasiveness of greenwashing among the biggest and most popular ESG ETFs. Could you please expand on what you mean by this?
Sure. I mean, when you're talking about a diversified portfolio, a portfolio that's investing in everything from an Apple down to a Southern utility company, ESG covers a lot of different things, and there's a lot of different aspects of it that are going to apply more intensely for certain areas than others. You put an ESG label on a portfolio, you kind of expect it to do certain things. And when it comes to carbon, in particular, carbon emissions, the biggest portfolios at least in the United States, tend to be a little heavier on the carbon than investors should expect. Investors should expect those managers to make better strides on the carbon emissions in their portfolio. And that's what I'm talking about, is the amount of carbon the intensity of the carbon that's being shown in these portfolios. One of the things that we use for that is the way we measure intensity is with greenhouse gas intensity. It's an apples and apples comparison across businesses. And it's measured in tons of CO2 equivalent emissions per $1 million of revenue, right? So that allows us to look at what a big company is emitting versus a small company. You don't just buy really small companies that don't emit a lot of emission. They could be really bad emitters, but they're really small, so who cares, right? It also adjusts for methane versus CO2. It's a way to look across businesses, right?
I think, Jordan, you had some slides. I don't know if I were talking about particular ETFs or looking at what kind of diversified portfolio you think works best for.
Well, I think a good thing to think about is just what should you expect from an investment, right? So like if we look at, these are the reality of the S&P 500. The S&P 500 is top heavy. So if you look here, you see that the S&P 500 has a greenhouse gas intensity. This is the way we calculate it. It's very close to what MSCI does, but it's one that I can actually pull the numbers for each individual company. 140.7 tons of carbon per million of revenue for the S&P 500. That's 505 names, 100% exposure to the market, 100% exposure to the carbon. If you just remove the 5 worst emitters per sector, so there's 11 sectors, so you're only pulling 55 names, you reduce that intensity by 37%. And you still have 94% of the exposure to the S&P 500. You take it one step further, you remove the worst 10 names per sector. You still have 80% of the exposure of the market, and you cut the CO2 exposure in half. So my point with that is simply, it doesn't take very much to really impact the carbon intensity of a portfolio. So what are the big ESG portfolios doing? Well, this is the big diversified ESG funds. And so these are the top 6 diversified funds that you can see here. Mm-hmm. And then I've thrown in the fund that I have. This is not in the top 6, but just to give you an idea of what you can do if you pay attention to carbon. So you can see that all of these funds are, betas of basically 1, very high correlation with the market. So they're very much going to be S&P 500 exposure. This is their intensities. I mean, you can see the S&P 500 fossil fuel reserves free one is at 132, all the way down to 68. So there is some improvement with these. You can see this is the calculation that I've done. This is that MSCI one. So you get it from 2 different sources. They are very, very close, within 5 tons of each on most of them. So that's what they look like. So what happens if we blend these together? You can see how they just really aren't doing enough. If you just remove 5 names per sector, you can get to 88. All of these funds that are, SPYX, the ESGU, SUSA, DSI, they're not doing enough. It's not enough to be at that level of intensity when you could be reducing it so significantly with very little effort. And that's what I have a problem with. And you can see down here at the bottom, this is the fund that I run. We actually pay attention to it. We have a diversified portfolio that is invested across the S&P 500. Our intensity is 17% of the S&P 500, and we still have S&P type exposure. And that's what that type of reduction might be more extreme, but I mean, at the bare minimum, you should be getting at the levels where USSG and SUSL are. I mean, all you have to do is pay attention to it, and you can really change what your carbon intensity is. And, you know, just to, not to pat my own back, but, you know, a lot of people will say that, you know, if you do this, you're going to be giving up returns, you're going to be paying attention to the wrong things. I disagree with that premise entirely. Carbon is changing, is going to be changing. It's going to disrupt businesses. It's going to disrupt the way businesses operate. If you're carbon intense, you're going to have to change your business. That's going to be very expensive. That's going to affect shareholders. And I think that's reflected in the stock market. And you can see it here. This is total return since we started. And this is our portfolio is the third best returning portfolio. And it's beating the S&P 500 by 6.5%. You can reduce by dramatic levels and still beat the S&P 500. It's done. It can be done. We've done it. SUSA has done it. They haven't reduced their carbon emission as much. They've only done it by 25%, but you can do it. And it's one of the things that I like to point out is that when you're making this choice, you're not necessarily choosing between returns and the environment. You can do both, because the environment's going to matter for returns long term. If you're positioned to protect the environment, you're positioned for the future, you're positioned for better investment long term.
And just out of interest, what kind of equities do you not have in your fund that are in these ESG ETFs?
The only sector that we don't own is the energy sector. That's about 2.5% of the S&P 500. We own other positions that we consider energy, solar, wind, those type of things. But we don't own energy, not because they're quote unquote bad. The problem with energy is a lot of them carry a ton of oil assets that are untapped. They're on their balance sheets. They're going to have to write those off. We're never going to drill deep water drill again. That just doesn't make sense. That kind of expensive, capital intensive, you're not going to have another North Sea. You're not going to have, that just doesn't make sense for a company to do. And so those assets have to be written off. And so we don't own them because we don't like their earnings profile long term. We also think there's better opportunities out there than the energy sector. I think my final point that I would like to make is just, you can diversify, you can have exposure to broad markets, and you can still be aware of this stuff, and you can still get returns. It's just a matter of making the effort. I honestly think the next phase of ESG investment and of impact investing is going to be when investors themselves kind of start looking under the hood. The regulatory regime that's going in the EU is going to help with that. It's going to make investors want to understand what they own. When you have 15 funds and they all look the same, at some point you want to understand why they're different. Yeah. I think investors are going to start looking under the hood. It's going to start mattering more what you own, and that'll be the next stage of growth.